So now we're going to go into the trust purpose. The number one purpose for a trust is to preserve and pass on wealth to your posterity, your children, your heirs, etc. Secondly, to preserve wealth and protect property, and to shield yourself from many of the commercial burdens and intrusiveness of some taxations. All right. This is made easier with a trust because money can be put into a trust and it does not have the burden of being taxed at the same rate that individual citizens are. And there's also the fact that multiple parties are committed to grow profits from the assets placed into a trust and are provided certain powers and protections not accessible to everyday family economies. So, what do we mean by that? There are many, many ways that a trust can protect you and can protect your assets. Many more than just this basic example of what I'm giving, because this basic example is one example and it's only regarding taxation. Trust can protect you not only from taxation, but fines, fees, etc. That individuals or citizens or individual citizens cannot escape. But we're going to keep it simple, and I'm going to give you a basic example just regarding taxes, how the trust can save you a lot of money. Because remember, the businesses that we discussed earlier, that in the early 16 and 1700s were likened unto kings by these congressmen who saw fit to squelch their power. They were able to amass this power through the inordinate or a massive amount of protections they had because of the trusts that they formed. You know, they were protected from certain fees, they were protected from taxes, they were able to form uh, contracts at will in order to bond or form what they called cartels with other companies, and those companies could share in the benefits, and that was more incentive to get these cartels to function together to amass wealth quicker. I mean, the fluidity is incredible. All right, but we're going to go back to this base example. If you have a business that generates $10,000 monthly, the trust can charge the business to do accounting for the business $1,000. Okay, for example, this money goes into the trust, reducing the taxable profit margin. The trust can then claim upkeep of the property as exemptions, or rather, the trust can claim upkeep of the property as exemptions also. Okay, $500 for per this example. And also, family members can assign income to the trust in the same way retirement or pension accounts receive deductions from employees, i.e., Roth IRA, 401k, etc. And let's just say this is $1,000, leaving a taxable gross balance of $7,500. Much better than being taxed on $10,000, with the $2,500 still allocated or going to the family wealth accumulation. So let me break this down. If you have a business that generates $10,000 monthly, all right, and you put that business into a trust, the trust can charge the business to do accounting for the business, or the trust can charge the business to do accounting. So, for example, you have a trustee of your trust that can also be a secretary for your business. Now, your secretary, as a trustee of your trust, can say to your business, can write a contract and say, listen, we're going to charge this trust $1,000 monthly because I'm doing the accounting for this trust. Okay, that money goes right back into the business, but it goes out of taxability, the taxable amount. You see, um, so now your taxable amount on your monthly gross for your business is only 9,000 versus 10,000. Now, the trust can also claim upkeep of the property as exemptions. So now, if your trust has this business as an asset, if your trust is holding this business, your trust can pay the taxes, or it has to pay the taxes basically. Your trust has to do the upkeep for the business, repairs, maintenance, etc. And let's just say it charges your business $500 a month to do that. All right. Now, out of the $10,000 that we had previously taxable, we only have 9,500. I'm sorry, 8,500. All right. So 8,500 is taxable versus $10,000. Now, also, the employees, who are your family members, can take from your business and put certain parts of their, or certain amounts of their pay into the trust, and the trust will treat these as a pension account, just like a Roth IRA account or a 401k that your employer would set up for you if you would work for him or her or it. They would have a pension plan for you where you would allocate a certain amount of money every month, and that would develop into a retirement plan for you. Your trust can operate the same way, okay? But the money is going right back into the family economy, and again, being taken out of that growth, that monthly taxable amount. And let's just say that is an accumulate of $1,000. Now you have $25,000 or $2,500 taken out of that $10,000 as a monthly gross, and now your monthly gross is actually $7,500. Now the IRS cannot tax you on 10,000; they can only tax you on 7,500. Okay, and even further down the line, that is a rate that is far below the individual rate that the taxation tables occur on. So um, that is just a basic example, but it shows you the incredible power that a trust can have, even in the business aspect, when the business is run by the family, or even if the business is not run by the family. Money's taken out, they're removed from taxation and put back into the family economy, the family trust structure, to still make money for the trust, to still be a part of the trust assets, all right, and gain wealth for the estate. So I hope that made that clear. Um, any questions that can be addressed via email or a consultation. But that should be very, very clear, and that should be a very powerful example to show you how this trust can benefit you.